Hello and welcome to another episode of the Swing Trader Status Update. My name is Justin Nielsen and I will be hosting today. Normally we do this on the second Tuesday of the month, but since there was the Veterans Day holiday, even though the market was still open, we decided that we wanted to go ahead and shift this one more week. So here we are kind of in the middle of November. We've got a Thanksgiving holiday coming up and still a tough October is spilled into November. And to kind of help us decipher what the heck is going on in the market is our senior market strategist, Mike Webster, the brains behind the SwingTrader product. I'm just here to do the Excel spreadsheet along with Julie. Yeah, do those stops and everything else. But how you doing, Mike?
Dude, do you see all the blood around me? Like
Yeah,
it's been pretty choppy for like really 2 months. It's
wow.
been the way I was explaining it to some other people was this has really been like kind of the kryptonite market for this strategy. Swing trading, my style with, buying strength, buying upside reversals with tight stops. It's just, man, very, very difficult. And we'll get into it and you know, there's no end in sight right now. We will see.
Right. And look, we've got some potential catalysts, right? We've got Nvidia earnings tomorrow. We've had a number of upside reversals. Actually, you know what? Before I go through our performance numbers, let's just kind of do an overview of the market. I'm going to go ahead and share my market surge. That is assuming I can find it. Oh, you know what? I'm going to share your market surge. How about that? Um,
Sure.
here was Oklo that we were working on for a different project, but um, here's the NASDAQ composite index. And man, we've had some nice upside reversals. But the problem is that we get the upside reversal and then what we like about upside reversals is how you can kind of manage your risk and you know when you're wrong. But what happens is you get this move down below the lows where it's like, okay, you're wrong, but then you get an upside reversal again. And it seems like there's enough buying to kind of prevent the market from going down too much. The pullbacks are getting people excited and doing some buying, but it's not enough buying to really kind of turn the tide of this pullback and turn the short-term trend back to positive. We still have the 21-day moving average line in a downtrend. The 50-day moving average line is in an uptrend still, but it's starting to flatten out. And look, this power trend is in danger of turning off. We talk about the power trend in market school rules, and it's basically we had our first kind of shot across the bow with the close yesterday below the 50-day moving average line. So that's a big deal. Further destruction today. And if you see that 21-day cross below the 50-day moving average line, that effectively ends the power trend. And you could see that happening, not too long if we stay down here. So, Mike, give us your thoughts here on the market.
Yeah, so I would say you have all excellent points as far as the power trend goes, and the power trend is a very special thing. It's something that we came up with, you, myself, and Charles Harris with market when we did market school is a big part of that. In fact, probably the most important part. And if people aren't familiar with it, it's just very simple. It's a big trend up, and how we define that is with your 21-day being above your 50, your for 5 days, your low being above your 21-day for 10 consecutive days. Those are your key things. There's some other stuff involved with it, but then it ends. There's different ways that it ends, but essentially with your 21-day, the green line going through your 50-day. So it identifies this very special time where you can make a lot of progress, which a lot of progress was made during that. But at the end of them, the trend is your friend until the end. And you'd almost rather it just fall right apart. Like on
Mm-hmm.
October 10th, if we would have just kept going down lower after that, all would have been good because we would have just stayed out of that environment.
Absolutely.
But this was where the kryptonite was. That like that happened on a Friday. That was bad news, and then you just there was negative news there, but over the weekend you had positive news, and then you had this gap up, and you have to react to what the market is doing, not what you think it's going to do or what you think it should have done. And that was, got back above the 21 day. You had that powerful. Could you just point to that day so everyone can kind of see it? To us, it just jumps out. Like it's the only thing I see is the October 10th.
Yeah, so
Um,
this is the
yeah,
October 10th. So
yes.
it got kind of established this range with the high and the low, and you kind of were trading in between it. And as you said, you gotta you gotta break one way or the other eventually.
Yeah, and then that broke. Well, really, it kind of started with the day after October 10th, where you had that gap up on that Monday because there was positive news over the weekend, and that kind of threw everything off because the market needed to resolve itself. When you had that big down day on October 10th, what would have been normal and natural would have been an intermediate correction, or at least another 2.5 day, another 1.5 days down from there, a break of the 50-day, and then the following day, an upside reversal. That would have been your base case. And that's what we were planning on. But news happens, and then so it moved up into that trading range and really should have gone sideways much longer. But the market does what it wants to do. Then it broke out to the new highs. So you have to be aggressive at that point, because I was looking at that, and given that same information, I would think the same way. It looked like the beginning of that last run in October of 1999, which we should go to 99 in a little bit, but not yet. And you have to press the gas on there. And that's what we did. And then it came down, and it tested your 21 day, then tested the 50-day, had your really nice upside reversal off the 50-day. And that's where you want to gun it. With this style, you would want to gun it. Then your low gets above the 21 day. You want to gun it some more, and then it rolls. And then you have an upside reversal a couple days ago, and then that one fails. This is chop. It's, there's no perfect system in the market. There's no system that is going to work every month or every quarter the way you'd like it to. And if you can switch from one system to another and then back to another, and you know which one is going to work that month, more power to you. But that's kind of not how it really works. You have a strategy and you stick with it. Um, and honestly, in hindsight, given the information that I had at the time, would have made the same decisions. I might have changed it a little bit, but still we'd be in a big drawdown, because that's just the way the cards fell. So what do you do at this point? We're staying light and working on the areas that are working. And right now it's clearly medical that is hot. Now that might change after Nvidia's earnings report tomorrow after the close, and then once we start getting the economic data, because obviously most of the economic data was sidelined during the government shutdown. And so as we start getting that information back, the normal information flow, the market should get a little bit more normal. But you know, we're going where the puck is and has been going, and that's medical. And we've tried some other things, but then we just get kicked out of it. And so we're just going with what's working. We're being cognizant that we're so heavy in one space that some negative news could really hurt us a lot. But that's why we're not 100% in medical. I'd be comfortable with maybe even 50% in medical, depending on how we're doing that. We'll get into the stocks that we're in a second, but doing it via ETFs and some like quality names. But still, even a quality name, like I'll just talk about Lilly, which we're going to talk about in a little bit, that I have a position in and that we have on the list. If they go and acquire somebody, which could happen, that's what happens with big medicals, that thing is going to gap down and it's going to hurt us. So you don't want to be too heavy, because that could happen to any stock, but you can't trade scared. You got to just trade what's in front of you. And right now it's clear that medical is still solid. I think gold is still makes sense. That's a place that we almost bought back today, but we were just being on the cautious side because of the drawdown that we're in, and we just don't want to stick our neck out unless we get very clear signals. And they were gray signals. It wasn't like we had to buy it, so we backed off, because the feedback we've been getting from the market is clearly, the stove is very hot right now. Until we get back above the 21 day, we're going to try to tame, keep things on the tame side, unless you get a big upside reversal. But we've seen that recently not work out so well. So, man, it's just really hard. That's the way
Mhm.
it is.
Yeah. And
And
I'm going to go ahead and just show some quick performance numbers while we're kind of here, just to show again. October was really tough. As you said, that October 10th really kind of started things off on a sour note, and it was really hard to kind of, um, we were very light for most of October and had a lot of underperformance. Now for November, we're getting a little bit of outperformance, still down 2.5%. That's not fun, especially after a month where we were down 3%. So again, that's led to a larger drawdown. Um, Even a larger drawdown. Here's our off high. And so this is kind of showing the drawdown. Even a larger drawdown at this point than what we had back in the whole tariff tantrum. And again, it goes to show how, like, exactly what you were saying. If from October 10th, if we had just kept going down, that would have been easy, because
yeah,
we would have just been, oh, okay, we stay
out.
out, and we would have cut this off right about the same level as our drawdown from the tariffs, and it would have been a piece of cake, really. But it's because we had those upside reversals, the move to new high, all of that really has kind of made it a lot tougher. So, and look, I'm in the same boat. I was looking at my own equity curve, and this is September 22nd. We were up 31% for the year. A lot of outperformance versus the S&P 500. I'm not sure. There's my arrow. So yeah, 922 is right here. A lot of outperformance versus the S&P 500. We still have a lot of outperformance versus the S&P 500, but again, it's just we've come down quite a bit. We're below our 10-day. We're below our 21-day. Someone was asking in the YouTube, like, why not go with smaller position sizes? And we
Well,
have for a while been doing half position sizes. Frankly, Mike would love to go
well,
to quarter.
let me answer that directly, because we have a product that a lot of people take. The way I want to do the product is different than how we do it, and it has how I was doing it for a while, and we got a lot of negative feedback that folks just couldn't handle all of the alerts. The right way to do this, and the way that I would suggest folks who are following SwingTrader to do it, is if we put on a full position, really contemplate taking a quarter position. That's what I want to do. But then that would mean for every one alert, we're going to have four, because the right way to do it is in this environment, put a quarter on. If it's working, add a quarter. If that's working, add a quarter. If that's working, add a quarter. So pyramid into the full position here. But because we got so much flack for having so many alerts early on when I came back to IBD, that we kind of switched it and said, okay, we're going to do it more in big moves rather than incremental. And this is the downside to that. And we're really debating whether folks can handle doing it the right way, which means, you might get 20, 25, 30 alerts in a day instead of, a quarter of that. Can people handle that? Um, and we would like your feedback. But the bottom line is, you don't have to do it at the pace that we're always doing it. And go back one slide, and I just want to kind of talk about the drawdown one. So with this, when we were at that point where, and I think it was last month, where I said, okay, we're probably next month we're going to have a bigger drawdown, because we were at our lows, or we were already at a drawdown at that point. It was like, we could either just sit it out the rest of the year and just call it a year and lock it in. But that's not what people are, paying to take a product. Is like, we had to give it a shot when we got our signals, and then you take them, and then you're playing with those chips that you have. Like, let's go forward to the slide of the performance versus the S&P. So with this, because we had the differential, even though it's gotten a lot smaller versus the S&P, those were our chips to spend. If we would have been underneath the S&P for the year, we would be playing a different game, and we wouldn't have taken those shots, because we wouldn't have had the chips to spend. So we took the opportunity. It didn't end up working out, but frankly, besides doing it more incrementally, um, given our current rules and the way our style, I would do it the same way, even knowing the outcome. And that's The reason why I say that, let's go back to the NASDAQ chart or the S&P chart. That when you go back and you study your trades, good, bad, and indifferent, you want to put yourself in the mindset of the information that you had at the time. What would you have done? Because that's how you learn. And you make mistakes all the time. I always say I make 51 and a half mistakes a day on average. But the reality is we all make mistakes. We all also do things right. And you want to be learning from both. What are you doing right and what are you doing wrong? And I think I would have traded it the same way, even with the outcome. There are always little things I would do differently, but for the most part, this was just chop. But those people who are following it, you can dial things back. And right now, we've been doing halves for individual stocks and fulls for ETFs. So a 10% is a full, and obviously a half is 5%. So you can do those quarters and even 1.25s if you want.
Yeah, so a lot of flexibility. Again, I hope that people aren't looking at this as the singular way to do it. It's kind of a guideline for educational purposes, and hopefully, and that's why sometimes we even struggle. Should we even show performance numbers? People like that, but at the end of the idea, at the end of the day, we really want to be kind of an idea generator, and then someone can use their own system rules to do things. So yeah, I mean, there's so many other ways that we could just be throwing ideas out there, but people want to see how you handle them, and because that's where it gets tricky, right? You can throw a lot of ideas out and then say, oh look, I'm just going to cherry pick the ones that worked and show how great we are, but because we kind of you know put our necks out there and say, oh, we're doing a position size of this much, and then we have again all of our spreadsheets that basically track how the model portfolio does, with the alerts at the time that they're given, and so on. Sometimes that's great, again, like it has been for most of the year and still is. We're still outperforming considerably, but again, that drawdown has really kind of tempered the enthusiasm, and especially it's tough for someone that didn't get the benefit of the first half of the year, and they might be looking at the second half of the year and be like, man, I can't make this work, type thing. And that's just a function of the market. It was a very different time in April, May, June, versus what we've been seeing here lately. I also want to just point out, I'm gonna do this real quick to kind of show the time in which we did get a little bit more gassing it. So right here at this upside reversal that Webby mentioned before, support at the 50-day moving average line, we got the low above the 21-day moving average line. Was this basically the shutdown? This was the shutdown news, right? That it was basically they were coming up with a deal, if I'm not mistaken.
I believe so,
Yeah.
but at this point with all the projects we're both working
Yeah,
on,
yeah.
it's
So
like it's a mess in
because
my head.
this downside here was because of the China back and forth, rare earth metals,
Yep,
okay, tariffs,
definitely not.
that did get resolved early on, and that's what kind of punched us to highs. We came down, but then the shutdown is, a deal was looking like it was in the works over that weekend. We gapped up and we were gunning it after an upside reversal and a move like that. You do kind of that's what you do.
Wait, go back to the chart for a second because I think this would be very important for folks to do. And let's go to the day of where we hit the 50-day and do a change day to that. And just say, okay, you're a swing trader and you come down exactly how you would want to. You get support above the October 10th low. You have a clear and decisive upside reversal. Sometimes they're gray. This was like screaming upside reversal, support at the 50-day. What do you do there? You gun it, like, because now you have the low of that day as your stop. Now give it one more day. Now you do it does exactly what it should do. You get a gap up low above the 21-day, closing near the highs. What do you do there? You're increasing your positions, because at that point, what would be normal and natural is to go straight up to new highs. So if you don't do it then, when do you do it? If you're swing trading, you've got to do it then, because if you're position trading, it means your stop can be 7-8%. But if you're swing trading, your stop is going to be typically 3 to 4%. There are exceptions. And so you have to be doing it at that point. And so that's the information that you have at the time. And that's how I think everyone should go back and do their. Now, maybe some people have figured out this market and they're just locked in and they're just killing it over the last 2 months. Dude, more power to you. I'm very happy for you. But go back and study things if that's not the case, and just ask yourself, would you do the same thing again? Frankly, I would. It just doesn't always work out. It's like you always tell the blackjack things. If you've got an 11 and the dealer's showing a 6, you're going to double down every single time. It doesn't it doesn't mean it's always going to end up working out. Let's go back to our current.
And if you do double down and it doesn't work, you don't say, "Oh, that was a stupid thing to do." It was like, "Oh, okay, it's an odds game and it just didn't work that time." It's not a 100% guarantee. It's a 80, 20, whatever it is. And again, when you do have an edge, you try and go for it. And this did seem like a place where we would have an edge. But again, I wanted to show kind of the chart that shows our portfolio ATR, because what we did here, this is when we gunned it, and for the most part, we had been, kind of sticking a little bit on the lower ATR side. And just for those that don't know, ATR is average true range. So we were looking at those things that don't move quite as much, a lot of ETFs, and a lot of cash. That's kind of what you can see here, that, we had really kind of come down quite a bit at the end of the month. We ramped up, and again, ramped up in November.
But I
November
will
7th,
say
but
that
back
from
down to 50.
memory, yeah, I will say from memory, a lot of that percent invested was really like kind of inflated, because we were doing, I think that's when we were doing like individual, like SPY singles instead of UPRO, and where we were having like big positions in single ETFs, so they had lower ATRs, but we were getting that percent invested up there versus, let's put it this way: you can either buy a 10% in SPY, or you can buy a 10% in UPRO, and there's a time for each of them. The UPRO is 3x the SPY. So when you're looking at the green area, the percent invested, you also want to be cognizant of how much risk are you really taking. That's why we have the portfolio ATR. So go back to the portfolio ATR. This might be a lot of mumbo jumbo for people, but it is important to know. This portfolio ATR is the amount of risk you are taking. Anything 4 and higher is like you're really gunning it. Anything 3 and less, you're kind of, it's more on the mellow side. So you can see there, we've been taking it on the easy side, with the exception of those times where it made sense to push it. So we'll probably, keep this on the low side until we start making some forward progress. But can we go back to the charts? There's something I wanted to kind of share that kind of illustrates the pond.
Market search charts.
Yeah, the market search charts.
Okay.
And let's pull up the IBD 50, the FFTY. Now, I don't like using this for my analysis for all sorts of reasons. And I don't use it for market interpretation at all, ever, and under any circumstances. But this is a good way to illustrate the type of environment for our stock. So this is the IBD 50 ETF. And how much is that off of its high? If
18%.
Yeah,
Yeah.
18% in just a couple weeks. And that's what we've been dealing with. So that's the pond that we're fishing in. Now, it's not perfect, but pull up ARK K, because that's another one to kind of look at to give you an idea. And these are the high octane names. And
This is down 19% off its high.
yeah, So that's what we've been dealing with. That's kind of our style of stocks that we're trading with. And so just very choppy and sloppy. So what do you do now? What do you look for? Let's go back to SPY.
You know what?
Uh,
I did
oh,
want to also address that someone was
sure.
saying that maybe their numbers, their drawdown numbers, were a little bit different from mine. One thing to keep in mind is I'm not doing highs or lows of the day. It's only kind of where the equity curve closes at the day. So, um, that drawdown did get worse. Was probably worse at one point, and maybe we were off the highs by, I mean, off the lows by the time the close happens. And also just know that um, the way that I do the 10%, because again, it's how you do that. Everything has shares, right, in the spreadsheet. The way that we do our calculation is that it's 10% of the portfolio value of the previous day. And so that's just to keep it consistent. That's the way that I calculate the shares, and it's always rounded, to get it as close to that 10% of the previous day's value. And
Yeah.
that's how the calculations are made.
And
Okay, I'm
that's the
sorry to
right,
interrupt you.
and no, and that's the right way to do it. And keep in mind the highs aren't on there either. So
Right.
it's just a
Hmm.
closing value, and it's the same thing for the S&P. So when you look
Yes.
at
Hmm.
big upside reversals, well, at the bottom of that day, you were, and it would be the
The
same
drawdown
way. It
was
would,
worse at the bottom of the tariff stuff. The
yeah,
drawdown was
it
worse
was a,
significantly.
yeah.
Yeah. Mhm.
But it would be nice to have the highs and the lows on there, but that would be a lot of programming involved. It wouldn't be anything that you could do solo. But let's go back to the SPY and just kind of, because that's where I think we should be focused on right now. Um, and with this one, can you get rid of the quarterly stuff so we can just blow this up a little bit so I can see yeah, turn off the all boxes. Okay. So with this now, what's good about it and what's bad about it? Okay. What's bad about it? Our high has been stuck underneath the 21-day for several days. Our high is now underneath the 50-day for the first day, and we've had two closes below the 50-day. That's very bad. The What's good about it? We're still above the October 10th low, so we don't have a lower low yet. And an uptrend is defined by higher highs and higher highs and higher lows. So we still have a higher low there. That means we're still in this uptrend. And on the positive side, the 21-day is still above the 50. Now, on a negative side, if we don't start moving up that soon, that 21-day is going to cross
Mhm.
through the 50-day, and then it's going to end the power trend. That doesn't mean that the market falls apart. It just means that special time in the market will have ended, and kind of feels like it ended 2 months ago, even though this is continued on. So what are we going to look for? One, it's really tomorrow. There's not a whole lot you can do because you're in front of this big
Right.
risk event.
Yeah.
You've got pull up Palantir for a second, because that was our like a precursor to Nvidia. And if you haven't been paying attention, this bull market's been about AI, and the AI is just like the internet and that whole thing. And I totally believe that. But if you go back and study the internet boom, it didn't go in a straight line. You had wiggles and wobbles and bear markets along the way. But this was Palantir was the poster child for things, and you had a really good earnings report, but you had a negative reaction to it. But Palantir didn't fall apart. It's just base building. With this base, let's go to the weekly, and you can turn the boxes back on if you want, um, to just show, yeah, all boxes. We can go to the quarterly numbers because this would be kind of important for look at those numbers. You've had acceleration 63.78, 110 on the earnings, and you have acceleration of the sales going from the entire time from 20% steadily up to 63%. So great fundamentals, but it was already baked into the stock for now. And does this look like it's topped? I don't think so. Does it look like it needs to put in time and could go lower? Yeah, it pretty much does. With that said, let's pull up NVIDIA on the same weekly. And that's what reports after the close tomorrow. And that's what everyone is looking for. So kind of Palantir was your high octane version of the AI, and NVIDIA is your quality one there. And let's go down to the quarterly numbers that we've got on this one. Really impressive numbers, but the stock hasn't been going anywhere recently. It's just been kind of base building. So let's go to the daily on this one. It's in a position that if this lifts from here and runs up through 200, it should lift the market, and then we would be looking at the S&P probably moving back up through the 50 and near the 21, and the same thing for the NASDAQ. So that's one possibility. The other possibility is that this ends up like Palantir and then goes lower, and then you're looking at 164 or so is going to be the key level for it to stop. So you've got this bigger risk event that comes after the close tomorrow. So you don't really want to do much in front of that. And then we start getting economic numbers Thursday morning. So you're going to have that reaction. So you kind of have to just wait and see. Puts you in a really tricky position from a swing trading standpoint, because then you're dealing with gaps. And that's
We also have
why,
to acknowledge that there is a risk that things could be glowing and great with those earnings, and the medical, money's going to shift from medical back to AI, and we're going to be like, ugh, so we're not going to have the exposure, the gap. It's a risk either way, right? If we go heavy in AI and it doesn't go the way that people are hoping, then things could really get ugly really fast. So yeah,
exactly. And that's why
there's
we
no
have
edge,
such a,
right?
there is, I was telling you earlier today that this is the Bono solo market.
Yes.
Somebody please get that. It's
I'll-
edgeless. You too. I'm sorry. I had to do the musical right. Like one, maybe three people got that. Tell me in the YouTube if you got it. But anyways, you don't have an edge, and that's why we have so much cash, and we're just waiting for that. And what I was talking with you and I think Chris earlier, was the worst case scenario would be a big gap up on Thursday that fades. And so anything can happen. It's like the box of chocolate that Forrest talked about. We're just going to have to wait and see and just follow our rules. Our rules are based around the 21-day primarily, and our high is underneath that. So we're going to have to be light. Now, why don't we switch gears? We've been so negative, Nelly. I feel like Ed Carson talking about certain stocks. Let's look at the positive
and
stuff.
again, just the last negative thing, because someone was commenting about, hey, it seems like swing trader is good in really good markets and really bad markets, but choppy markets it struggles. Yes,
Yes.
that is exactly right. The trends, that's where things are easy, and in choppy markets, that's where as Mike said at the very beginning, that's the kryptonite, for our style of trading. And again, this is hurting me personally too. I'm off my highs. My highs in my personal portfolio were back in September, and so it's been frustrating. I think my worst account is futures, so that's down a little bit more, but for stocks ranging between a drawdown of I think 12% to 4% in the ones that are more S&P 500 index related. But where do you want to go next for the positive side? Please tell me we're
Lily.
going to medical.
Yeah, let's go
Right,
to
okay.
medical. So, and one thing that I will say on that, like I was talking to Chris, and he's near his highs on his equity curve, and it's because he hedges a lot, and that's not something that we do on Swing Trader, and we don't short.
Mhm.
If we're in a bear market, I'll consider putting some shorts on, but we're in a bull market, and I don't want to put shorts on a product like this, because I don't think it makes sense for the vast majority of folks who will follow this. Now, inverse ETFs we might do, but individual stock shorts we're not going to do, but that's how some people have been able to make some progress in this market.
Mhm.
This is something I think has real legs. We always get the question of, if Bill O'Neill, the founder of IBD, were around, what stock would he be in? And without a doubt, I think he would be very heavy in this. It wouldn't be based on the weekly chart, and he was the king at weekly charts. This is a horrible looking weekly chart. If you do a week by week analysis of this base, you will come away with, it's very flawed. And if you don't come away from that, you've done your analysis improperly. But what has changed is the fundamentals on it. Go down to the quarterly numbers.
Oh.
I'm sorry. This is that big number in September, that 495%. When you get a move like that, and with the sales growth there too, this is, and go up to the annual numbers, if you don't mind. So with big estimates like that, 82% and 34%, that's telling you these earnings, at least the street thinks it's going a lot higher. Now, DC could get involved and change things with some new rules or just floating new ideas. That's a major risk. The other major risk that I'm really worried about is they decide to do a major acquisition, and then when a stock acquires somebody else, typically the stock that's acquiring the other one goes down. There are some exceptions where they go up, but most of the time they go down. That's our risk in this. But let's go to the monthly one on this chart. This is something that we might, if it plays out, we want to try to hold it into a position trade. This looks like the very beginning of something, where you've had a stock that has been a prior winner. And the way I look at it is not just the price that went up, but I look at the RS line versus its moving average, and versus that blue line, which is longer term moving average. And if you get a lot of distance above that over a long period of time, that by definition, by my definition, is a leading stock. Then it sat out. So the thought process here, we weren't just like moving into this space just because it was moving. It was more, it seemed like the AI space and AI related, the energy plays and any utility things and anything that was related to AI was just having so much volatility and going through corrective phases, that the big money was flowing into things that have been sitting out for a while. And this is, I think, the poster child and is the leader of this space based on its price action. Now we can go to the daily on this one, and it's just had this powerful move up from the the 864 range, and is holding above the 1,000 mark. And what I really like is it's disconnected, it's uncorrelated with the market in the short term, whether the market's going up or down. It's been going up, and then we had yesterday's action, which was getting support at 1,000 and just down a little bit. And as the market was firming up earlier, it wanted to lift. So I think there's still a lot of room on the upside. Now the risk is we could get shaken out with a test of the 21 day, and if we get kicked out, we'll be looking to get back into it. But I think these are the types of names that folks should be looking at. Let's pull up Johnson and Johnson, which is something that we didn't trade just because we were so heavy in medical. But I never thought I'd be looking at Johnson and Johnson and thinking, "Wow, I wish I had this." A funny story with Johnson and Johnson. Back when I used to run, just like I do, SwingTrader with Justin and Julie, that I ran a list with Bill for about 15 years or so, give or take. And whenever the market was uh, going through tough times, we didn't have a cash component. So we were always 100% invested in that product. What he would do is want to fill it up with a bunch of slow pokey names. And so every time the market was rough, here you go, let's put Johnson and Johnson on. It was kind of a running joke that we would just, when you put Johnson and Johnson on, or like some REITs or utilities back in the day when they weren't AI, is just a place to hide because we didn't have the cash component. But when Johnson and Johnson is looking good, and look at that, you move back up through your 21 day, each day is inching up, you're at a Livermore 200 number. this is a stock that we're looking to get into. Now let's go to the weekly though. And this is why I'm not hot and heavy on it. This feels like the market is just rotating into this space. Please turn off your best fit. Let's go to the, I didn't even have a connection. So let's go down to the, let's go down to the quarterly numbers to see why Bill wouldn't be in this one. He might put it on a list, but he wouldn't be in it. Look at it. Sales growth is pathetic and the earnings are pathetic, but money seems to be flowing into this. And it's something that I think you can swing trade and position trade. But unless there's some new product that comes along or some something else news related, it would just be like a run of the mill type of position. Now let's go to XBI, which I have a position in and we have on the list. And let's look at it on a daily basis. The reason why we're going with this is the stocks that look the best in the market right now that keep on popping through our screens are a bunch of biotechs. And there are so many. How many stocks are in the bios? Like 5, 6,
Oh, it's like
maybe more
almost
than.
800. In the
Okay.
biotech, yeah, the
And
biomed biotech, it's I mean, I could tell you in a second, but
yeah, I
it's
think
close
it's
to
like 8.
800.
I think you're right. It's in the 700 to 800 range. So you've,
Mhm.
and a large amount of those are looking good. And I think, there's all sorts of reasons why it makes sense that they're going up in a lower interest rate environment, which it looks like we're, going to continue into, as well as the AI helping them out. That this is a space that I think has big legs, but we didn't want to take the individual risk of some biotechs without earnings because yes, you can get those gap ups. They gap up a lot. They can gap up 50, 100% plus on some positive FDA news or any really good news, but they can also go down 50 or 80% in a day. So I think the way to do it is through ETFs. We happen to like XBI just because it is more spread out. I think the biggest positions there are maybe about 2%, um, if my memory is right on there. And this is just in a solid, steady uptrend. And after that upside reversal at the 21-day, it's been acting as you would expect it to, moving up and trending nicely, unlike so many of the upside reversals we saw in tech, non-bio related tech stocks. So you're just looking at where is the money going to, and let's pull up an Oklo, for example, is kind of one of the poster child for the AI thing, and that had a monster move, and now it's having this major correction. So this is, I look at this as kind of the heat version of um, of the AI space, and I look at the Palantir of the quality heat, and then the Nvidia is kind of the monster stock in that space. So we'll see how this that plays out, and I think it would be fine if the AI thing takes a breather for more weeks or even months, and allows some other stocks to come through. We've been seeing some energy stocks that look interesting. We just didn't want to jump in front of tomorrow's numbers after the close, but I think there's some other spaces that go besides medical, but we'll probably sit on our hands tomorrow. I always say that, and then some news comes out that kind of forces us to trade, but we will see.
Mhm. And just some correlation numbers because I created that spreadsheet, and this is a short period of time, but if we went to like October 1st to today, the XBI, the correlation coefficient versus the Qs for XBI is about 0.45. For
Well,
XLV, it's 0.11. For
wow.
Lilly, it's 0.06, and for J&J, it's negative zero point 0.4. So it goes in kind of the opposite direction of the market, at least
Why
again
don't,
in
why
that
don't you
short period of
explain
time.
it to folks? Because for many people, they know what you're talking about. Other people don't know what you're talking
The,
about.
the, the correlation coefficient, and this is something you can easily do in Excel or Google Sheets. You take two sets of data, and it'll give you a correlation coefficient that is from -1, which means that as one goes up, the other goes down, or vice versa. Or 0 means that there's like no correlation, whatsoever. And then a 1 means that it's, correlated very highly, to where when it goes up, your your sample goes up as well. When it goes down, so they move almost the same way, same direction. So again, there's you can't necessarily read too much into it, because those things can change. Remember, this is a look back period, that's historical thing. Even Oklo did get disconnected a little bit from
Hmm.
the cues, because it started coming down earlier. So Oklo, surprisingly to me, was it's got a negative correlation to the cues right now. But I'm sure if we went with a longer time frame, let's say to the April 22nd, 2025 follow through day, we'd probably be looking at a very different thing there. So Oklo in that case is a 0.88 correlation, coefficient, because again, you go for that longer period of time back to April, and the correlation is very high there. But if you go to just October, this has come down harder and quicker and everything, and is again more negatively correlated. So anyway, for more information on that, Google your correlation coefficient. There's YouTube videos on it and
It's
statistics
really
courses.
powerful. It's very,
Um,
very powerful stuff. And what it
and
will go ahead.
and it also, just so you know, in a strong market and in a bad market, the correlations sometimes get up there. And so this is one of the reasons why you have to be careful sometimes with a lot of quarter positions. If it makes, you know and look, Webby can handle more positions than I can't really handle more than 20. That's my limit. Once I get over 20, I make more mistakes, because I'm just not able to watch them as well. And when you get in trouble, you have to realize that a lot of times you might think your stuff is in different groups and you're diversified in that way, but when things really come down, the correlations, they call
They
it the
go to
correlation
one.
of crisis. Yeah, a lot of things get correlated, and so that diversification you think you have, everything's getting hit, and you're just scrambling to get rid of stuff, throw it all over the boat. And it's very easy for me, at least, to overdo it in that regard. That's why I kind of know my limits, and that just comes from getting to know yourself and know where your own personal flaws are. Now, that's maybe a flaw I can work on, but right now, given the workload just with my job, I don't think that I can tackle that flaw right now. So it's
I
just okay.
guarantee you. I guarantee you can't. Don't even try
So
because
it's like, oh, okay, well, reduce the number of stocks that I'm going to do, and it just means I have to watch them closer, and sometimes that means I have to have a larger cash position and not participate as much as I'd like to. That's where I'm at right now. But
well, I want to say this one thing on the larger positions, that some people think that like I will do a large number of positions for the diversification. I don't. It's not the diversification at all, because all the stocks that I'm going to be trading with my shotgun approach of doing a bunch I can do 50 positions, a bunch of baby positions, and I feel comfortable with that. But I don't have a false sense of security with the correlation with the market. But what it does allow me to do is it helps me with a FOMO, because if you have a bunch of little positions and you're timing it based off of what the chart is doing, and you're adding to the ones that are working, and then you're slow and you're quickly removing the ones that aren't working, it allows you to not have that FOMO, because you will have a piece of everything and you can quickly make it bigger, the ones that are working. So it's really a way of if you do a lot of work and you've got a large watch list and you know where you like to buy and exactly where to sell, I think it makes sense. But don't do it if it's not something you're comfortable with. Bill wouldn't do it that way. He would do his 5 to 8 stocks and he would pile it into 1 or 2 stocks. And that's why I was saying I think right now he would be in the medical space, because he would always do either retail stocks, medical stocks, and tech stocks, and then that's kind of was where the bulk of his. Can you think of anything else that he traded in a big way besides that? I
you,
can.
you you said medical, you said retail,
Retail and
uh,
tech.
and tech. leisure. I'd add maybe leisure in there because like your Brunswick and
Yeah, I kind of
yeah,
think of that as retail, but yeah, you're right. Like basically ways of enjoying life or saving
right.
money,
Hmm. Hmm.
But was there anything else that we needed to tackle? I
We
thought there.
we 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 should just real quickly. I think we covered XBI and Lilly, but let's go ahead and throw Amgen in there. And I know you've studied this a lot because this was one of Bill's babies back in the day.
Hmm.
The story I think you and I were both told was from Don Drake, the CFO of William O'Neill and Company, who was like, "Yeah, Bill had me shaking the couch cushions for more money to put into Amgen." Basically. And look, that's not the way, just to be clear, that's not the way Bill starts. He doesn't just start with everything in a single stock. It's usually, um, like what you do, Mike, just to a lesser degree. You might start with 50 stocks and then whittle it down. Let the market tell you who the winners are, and then you put more money into the ones that are working and less money into the ones that aren't, and that gets you a concentrated position. And Bill would do that too, but maybe he'd start with 10 to 12 positions and get that down to six, or even less. Um, Granted, he was uh, more of a cowboy when he was younger, an Amgen when he was doing that with a lot of the firm's assets in a single
All
stock.
of it,
Um,
all of the
yeah,
firm's
and he
assets,
did
because
that in with Qualcomm too in the late
yeah,
'90s. A good portion of the assets in a single stock. There were other stocks too, but Qualcomm dwarfed them. But that's not something he did. I think after 2006, or definitely
yeah,
not 2008.
yeah,
After the great financial crisis, I think he was done with that idea.
yeah.
Because
He definitely was. And in your story about Don telling us about the searching underneath the cushions for money to give to Bill for margin for Amgen. Let's just go there. It would be fun. Go to the Amgen in the 90s. And I do have a position in Amgen right now, as well as us having it on the list. And we won't go into this into too much detail, but it is worth, I think it was 91, right?
yeah, so right in here. So uh, whoop, and let me go a little bit further back. So
Yeah. So you can go ahead and put the best fit on for this, so folks can see where he was buying it. So, he had missed it out of that double bottom down there,
mhm.
and then was buying it out of that cup. So he had missed that full move. So the learning lesson here is you don't have to get it right away, and he didn't get this right away, and he ended up out of that cup building a position where the entire firm's assets were in this stock on margin. And he told me the story in detail a few times. And each time he'd say, "I've told you this story before." And I go, "No, no, it's okay." Because I
Say it
wanted,
again. Yeah.
yeah, say it again. Because he'd remember different things each time. And what I found fascinating is in that double bottom that was up there in like the June 91 timeframe, he went into Fidelity, who is one of the firm's one of his biggest clients, probably his biggest client, and they were saying, "Hey, you need to sell this." He was giving them advice, but that's his job, was to give them advice. But they said, "Hey, look, we know about your Amgen position. You got to get out of that. It's not looking right." But he stayed with it and he gunned it, and then he ended up selling it, a few weeks off of the top, in there, and that was. I think the most impressive trade way more impressive than what he did with Qualcomm. And in my opinion, I don't think Qualcomm was really that good of a trade relative to this. I think that the AOL Schwab were perfect, and this one was his best trade of his life, because he had all the chips there, the entire firm's assets on margin, and looking for more margin along the way, and then got out of it. And so he loved drug stocks. His first big stock was Syntex, and that was the pill. So he always kind of gravitated towards these. And so I think that there's a potential for Lilly and some of the others, to have big moves like this. We'll see. You can't tell the market what to do, but that's why I was saying with the Lilly, that we're looking to if it works out, to turn it into a position trade rather than just a swing trade. But I would go back and study that. I did do one of my own Webby Rambles On podcasts going over that trade in great detail. So it's on my YouTube channel, Webby 5150. So if you want to watch, if you're interested in that story, you can go. And I did one on Schwab as well.
You know what? I just wanted to kind
Yeah.
of end with a little look at 99.
Oh, that's right. Yeah. That was, I knew
So
there was something else we were supposed to talk about. So
um,
with this, why we wanted to talk about it was we were both saying how feels very reminiscent of 1999. Last month, I was thinking that we were in the October phase because that's exactly what it looked like. We were breaking out to new highs, and I thought we could go on that move that just where it gapped up out of that area, and it just never looked back. And if you didn't gun it then and you were waiting for the pullback, well, you never got that pullback until till January, and then you didn't want that pullback at that time. Obviously it topped out in March. But what Charles, yourself, and the three of us, when we were doing the market school rules in black and white rules that we created, 1999, as good as 99 was, we could never get it to really work well with that system because it just was so volatile and so choppy that until you got into that last phase of it, all of our rules, unless we wanted to data fit, just chopped us up. And that's kind of just like what I'm saying about this market with our style of swing trading. It's just chopping up. Whereas 1999 was this great environment, but the rules that we had that worked perfectly from 1973 to now, there is really this one time that it really didn't work well, and that was 1999, which is, I kind of find a little hilarious. But I would go back and study this because it was the same basic thing. You had all this excitement around the internet, which was real because we use the internet way more than I think anyone ever thought we would. But it had to go through these phases, and ultimately the 2000 to 2002 bear that kind of resolved the bubble. But look at that, there was only that time in June and July where your low was above the 21-day for an extended period of time, and then it was choppy. But during that time, there was a lot of money to be made just trading off the individual stocks. And I was thinking about it earlier after we were talking about this, Justin, is when I was trading my personal account at that point, because I didn't become a PM for him until the end of 99, early January of 2000, I wasn't really using the market. I was just doing individual stocks and just looking for the setups regardless of what the market was doing. And then that was what worked for 1999. Because
and just as an example,
yeah,
because again, like this April period, we were talking
hmm
about this earlier, and we can't show the AOL chart, but AOL topped right in here, and Schwab topped right in here. So I'm just
yeah,
going to show
let's
Schwab,
look at Schwab.
how different Schwab looked. I mean, it was ramping up this climax top. That was the top, and yes, it came back above its 200-day, but just this was the leader, right? In the
hmm
October 98 market, and it just acted very differently. Now, that was one case where it was ramping up, much faster than the market going into April, but then you had other stocks that were just falling apart at that point. And then when Schwab fell apart, there was a whole host of other names that were doing really well. But yeah, and then in 99, of course, you had another host of things that were doing well. So
exactly, well put. So in a nutshell, what I would say from a study thing, I would go back and study 1999. Any of the stocks that are still around that you can pull up in Market Surge, I would look at those, see how they traded with that market. And then for our current market, if we can go back to that, with this one, we want to really wait unless you get, a major upside reversal, which we will, take advantage of, even though we've had two of them fail. The one 2 days ago that failed, and then the one off the 50-day that failed. we're not going to change our rules. We're going to take that seriously and trade it the way we always do. But if that doesn't happen, we really want to wait until we get back above the 50-day and back above the 21-day before we start pushing on the gas, unless we find some things that are working. Like if the medicals really work, and we don't want to put too much more in that space. Like I said, we'll probably cap ourselves out around 50%. And we might just stay at where we're at, which is already heavy. But we're going to just kind of slow down, because what we've been doing, we've been getting chopped up. So we're going to reduce things. Do pay attention to the alerts that you get from us, because we're still debating this, the pros and cons. We might do it the way I would prefer to do it, by
And
doing
thank you for
quarter
the feedback.
positions.
A lot of
Yeah.
people did say more alerts, less alerts. It was a little bit mixed, but it was good to have some feedback.
Yeah, we love the feedback, and I'm only working on one screen, or I'd have the YouTube up to be looking at those comments like I did last time. But yeah, we might end up doing it more incrementally, and then that will just lead to a lot of alerts. But you can always just do it however you feel comfortable with.
hmm One other thing, just so that folks know, as you mentioned, a couple things we were looking at. We were looking at gold or GDX. These were looking set up, especially GDX here, just getting support right there at the 50-day moving average line. Again, we just didn't feel a big need to step ahead of this NVIDIA. Another thing that looked interesting
I
was
will say with
KIE.
the I will say with
Oh,
the
go ahead.
GDX, if you go back to it, if it takes out yesterday's high, we'll probably be adding it. Just
Mhm.
giving folks a heads up. And let's look at GLD really quick before we do the KIE, since they're similar. And with this one, it doesn't look as good as the GDX, but if it took out the highs from a couple days ago, we might do something with the GLD or the UGL there as well, because but more likely the GDX.
KIE was a decent looking setup, kind of getting this support right there. But again, they're just, yes, the relative strength is stronger on that. But if folks, get excited about NVIDIA, then you could easily see that money kind of move from defensive areas like insurance, into back on the risk on. So, was there anything else that we were kind of looking at, just to share
I
with
just
folks?
saw that it was an hour and 3 minutes, and
Oh goodness, yeah, we need to go. So.
I've got to hit the gym.
Yeah,
So
well, and my son just came home, so he's probably going to burst in saying, "Hey, Daddy, what's going on?" So, well, thank you so much, everyone, for watching. Again, you can revisit this video at your leisure, stop it, play it back, and speed it up. Whatever you need to do to get as much information as you can from it. Thanks a lot for joining us. We will see you in December. Probably on December 9th, I think would be our target. The
yeah, I
second
think so.
Tuesday of, as you know, Swing Trader Status Update, STSU, or second Tuesday Status Update. So December 9th is what we're going to be shooting for there. You're back from your vacation at that point.
I think I come back on the 8th. So
Okay,
yeah,
perfect.
most likely we'll do it the 9th.
Sounds good. Okay, we'll see y'all then. Thanks a lot, Mike, for sharing your thoughts, and thank you everybody for joining us. We'll see you next time. Bye now.